on the day that the index make their change of constituent stocks, the index shouldn't be changed much because it's such a very small percentage. It usually won't be heavier than 5%. So and then all other individual stock will lower their weighting, so the overall index will not change much. However, for individual stock that has been announced that could join the index, their reactions are vary. For example, 1211 and 968 during March 20th, they were all included into the Hang Seng Index. But from the announcement day to the exercise day, June 7th, 1211 actually climbed up a lot, more than 10%. But for 968, it's just remained flat. So the reaction is vary for each stocks. And also because most of the fund and ETF, they will start buying the new included stocks few days before the inclusion. So the actual movement is limited. Since the new inclusion or rebalance means that some of the index components will lower the weighting, so the overall index price will not change, so that the call warrant price will not be affected too. I don't think the after-hour trading section has much influence to the regular hour trading sessions, since during the nighttime, HSI futures usually follow the US index. However, recently there's the correlation between the two is very weak, so I don't think there's much influence. I think investors should not just base their trading on only one or two technical indicators. They should include as much indicator as they could. For example, RSI, MACD, Fibonacci line, SAR, Bollinger Band, things like that, and also moving average. So I would say should use more than just one or two. I'm using 9 days RSI and 12, 26, 9 for MACD. For forecasting the intraday movement, I think it's better off to look closely to the top 6 or 7 index weighting stocks. They are HSBC, Hong Kong Stock Exchange, AIA, CCB, Ping An, Meituan, and Alibaba. I think these 7 stocks could actually give you a better picture of how the market is at that moment in the short run. From the slideshow that I posted previously, the index was dropping from a low to 27,000 to another new low recently near 24,500. However, there is no RSI upward sloping during this drop, and the MACD is also downward sloping, so I didn't see there's a reversal pattern. So the best the index could do is to stabilize around 25,000. I will guess I will suggest the index will be have a very strong resistance from 27,500 to 26,500, and then we have a better support between 24,500 and 25,000. I think actually it is easier to trade put warrant to make money. However, if the index is closer to 25,000, I think it's a bit too low. So it's better off to wait the index go near 26,500 or 27,000. During this range, I think it is easier to trade put. And I think the index is at best is a range trade between the 25,000 and 27,000. I don't think within this 1 or 2 months there will be a significant uptrend. However, if needed to make the index getting lower, there should be more bad news from the US side. This is a tricky question. As I say, I expect the index not having a significant uptrend. So, but at this point to cut loss, I think it's a bit too low. So I still expect there for the next 2 months there will be a range trade between 25,000 and 27,000. So let's use this range to trade. Maybe buying near 25,000 and then sell on 27,000. Alibaba, I think, is a long-term limitation because a few months ago the government started treating Ant Group as a financial entity instead of a tech entity. So they are required to have a financial license for their banking service, like lending out money, and they need to put a lot of capital to lend out money. So I think the profit margin is already gone and is getting closer to a traditional bank. So I think the valuation for the Ant Group, if they have a chance to go public in the future, will have a significant cut down. So I think Alibaba, other business also has their limitation from the government. I think HSIs will perform better approaching the end of the year. By that time, investors should get used to the government intervention. And I think during that time, government has already placed enough control on the big corporates. And they could free their time to think of anything they could do to stimulate the economy. So I would think November, December should be a better month. And I also think that for long-term, Hang Seng Index will perform well after the mainland imposed enough control. Because there's a lot of sector actually the government is actually backing, and these sector will be included into the index. The next second sector that the government may look into it, I think, are those sectors that could drive up the production costs, such as steel, copper, aluminum, basic material. However, to influence the production of these sectors is not easy. So I think the government will take a look into the pricing mechanism, and for example, to see if there's some problem within the commodity futures market. So I think that's how the government will take a look into. I think the government intervention make the investor go into more defensive place. So those with high yield and very stable fundamental, such as utility, Chinese bank, should benefit by this government control. And I think the only factors that could stabilize the recent tech sell down are the valuation. So basically, if they go down low enough and cheap enough, I think the sell-off should ease. I think there's some sign investor could look into it to see the exercise become less bearish. For example, if the government start talking about internal consumption, like encouraging people to spend, buy car, home appliance, then I think it's a good sign. The market is having a better sentiment. And also you need to see a couple of weeks that the government stop imposing control to particular sector. The government actually have a couple of things in their mind that worry them. One of them is the birth rate dropping too fast. In the near future, they forecast there's not enough people working. So they are now trying to free up some household spending. So they just put an end to the post-education sector. And also they don't like any kind of excessive spending. So they see the tech giants growing too fast and actually do not benefit the economy. I think the best play for the Chinese EV sectors are 1211 BYD. It not just making the EV, and it's also producing the chips for it. So it's actually a tech company. Also, they make their own battery. So it's a all-in-one play. And the next one I like is Geely, 175. For the EV sector, I don't think the government will place any restriction. It actually will have a more supportive policy. I think the China renewable energy sector is the next best thing. I like the downstream play better than the upstream stock such as 916, 956, 836, 1798. These are all the electricity producer, and is the downstream play. For non-tech industry play, I like the 836. It has 60% of their electricity coming from renewable energy. So you actually have a very conservative play, a defensive play, and also you could enjoy the new energy ride. And I think the Chinese banks has already been pricing for those problems from Evergrande and Huarong. Any news from their problem resolving could benefit the Chinese banks. NPL, I think, is not a big concern for the Chinese banks and the regulator, because the Chinese bank is at a very healthy position. For the past 2-3 years, the government is already limiting the Chinese bank into the risky business. So I think it won't be a big problem. And also, if there's some problem emerge, the government will likely ask the insurance company to help. I don't like 1024 Kuaishou at all. I think the government don't see this business is healthy. It do not benefit the public. So it's not a good business at this moment. Well, Kuaishou has a lot of problem too. Recently, the cornerstone investor could starting to unload their shares, and also the ByteDance may go public will have a very big impact on the company. Yeah, I think institutional investor will will continue to invest in Chinese telecom sector, because the 5G, even 6G is keep going, and it's a very safe sector at this moment. It should not be affected by the government policy change. And I think the Hong Kong-China political conflict has been over. Now investors are more concerned about the U.S.-China relationship. And I didn't see there's a huge impact really happening now. You just see JP Morgan has been granted the first ever license to fully own a brokerage firm in China. So I think foreign investor will continue to go invest into China. Unless I see the China-US tension escalate to a next level, I don't see investor are extra worrying about Hong Kong freedom. I still think Hong Kong is one of the best free trading financial center in Asia. I think the government will continue to give pressure on the gaming sector and the entertainment sector, because it's used up a lot of the household wealth. I think the crackdown on the Chinese tech stock is a standalone event that should not influence other Asia market. But the sentiment that pulled down the index could affect some Asia market too. I see the foreign fund withdrawing from Hong Kong market happens every 1.5 years. So once things get stabilized, money will come back. So it's not a long-term effect. I think exercise will always trade into a discount comparing to the US index because of the political issue. I don't think the Fed will taper during this year. So very likely it will have some signal by the end of the year and also maybe the first half. But this all depends on their economy and more importantly the employment data. And by the time if the Fed signal are tapering or they give up a schedule, I think the exercise could go down 10 or 15% from this level, but it should be a temporary one because at that time Chinese government will put something and they may ease their liquidity.